Hi grade 12s, my name is Nomtaba and today I'm going to be talking to you about companies, the final accounts, final statements and notes. So before we get into it, I just want to say that it's very, very important for you to use past question papers. I can't explain to you how much of a holy grail those are, and they're available on the internet, so do a lot of practice. Okay, then the first thing is our final accounts. I hope you know that our final accounts are the trading account, the profit and loss account, and the appropriation account. Then when we talk about financial statements, we talk about, I don't know if you can, yeah, no, you don't have to say anything here. When we talk about our financial statements, we talk about our balance sheet, which is also called now the statement of final position. And then we have the income statement, we have the cash flow statement, and we have the statement of shareholders' equity. All right. So I'm just going to go over a few terms with you that you need to know going into the exam, terms that you will apply when you're dealing with adjustments, questions that they might give you, and questions you might see in maybe a mix and match column, and complete the sentence questions. Okay, so the first thing is IFRS. They will probably ask you to write the full statement, the full name without the abbreviation. So it is the Internal Financial Reporting Standards. And yeah, that's about everything you need to know. Then for GAAP principles, which are basically generally accepted accounting principles, they are divided into 6, and you need to know each and every one of them as per their definition, not only for the mix and match columns, but also for questions, because some questions will need you to be able to identify the principle in order to be able to deal with the question. So let's just define each principle. So the historical cost principle speaks to land and buildings. Usually it basically states that the asset will be valued at its historical cost. Yeah, that's basically it. So it focuses on land and buildings. I'll just put L and B here. Then the business entity principle speaks to the fact that businesses should be treated as a separate entity. So basically it just states that business are treated as a separate entity. That's all you need to know. And then, so I'll just write for you a little note so that you can, yeah. So business is regarded as a separate entity from its owners, obviously, so it is regarded as its own legal person. I'm just going to go randomly. The going concern it just means that you should work with all transactions assuming that the business will continue operating in the next financial year. So you'll find transactions where it's like you get a loan and that needs to be continued to be paid off. So when you record that transaction, you record assuming that the business will be running for those 5 or however many years you have the loan agreement for. So I'll just say assuming the business will continue to operate Okay, so the next principle that we're going to deal with is the materiality principle, which basically states that all information relevant to decision making should be provided. So basically it means you must consider when you get a transaction, consider whether that transaction is material, which means is it important to be included in the financial statements of that financial period. Then the next, so I'm just going to say consider if it is material. Or important. Then the next one is the principle of prudence, and that one states that inventory will always be shown at the lowest cost or the net realizable value, and not the amount the business could possibly receive. So this just means we should operate an assumption that we're going to get the lesser amount rather than a higher amount, because then we leave space basically prudence means you must be careful. So be more prepared for a loss rather than a gain. So I'm just going to say in your summary that always use the lesser value. Then the last one is the matching rule, which basically says that stationery unused for example, stationery unused at the end of a financial period must be seen as an asset and not an expense for that financial period, which basically means that you should be able to identify, like, in the sense, I'm just going to use the stationery example. With stationery, if at first it was an expense because we bought it and then we were supposed to use it, so any stationery left over in that financial period can't just be ignored or passed over into the next financial period as an expense. It then changes to become a asset because it's something we're going to go into the new financial period having, so it's a benefit on our end. So I'm just going to say that I don't think really I could summarize this for you other than saying that you should be able to think of if something was an expense in the past period and it's now something we have in our hands in this financial period and we can carry it over into the next financial period, then there's no reason to carry it over into the next year as an expense, rather carry it over as an asset. But other than that, I'm going to show you how to use all of these generally accepted principles, as well as how to enter transactions into your final accounts and financial statements and all of that. And everything that I've said today is basically going to come together and make sense in terms of why it's all important. But other than that, you just have to know this. That's all. And good luck for your exams. Yeah, that's everything. Bye.